All right. So what a difference 3 days make. So we're back again. Um, if you appreciate this kind of transparency, then definitely subscribe because I said originally I wasn't gonna hold things back and I was gonna show profits and losses. So we're gonna show the not so fun stuff. So literally in the last video, if you haven't watched that, I'll link it below. But obviously we were up about 9.77% on the year. Now, that's basically fully reversed. However, there's a caveat there, and we'll go over that. I'll try and make this one quicker than normal. I always say that, but we'll see. If you don't know who I am, I'm Ben Collins. I'm a CFA charter holder. I'm the founder and chief investment officer at Options Autopilot. And basically, I just want to do a follow up because obviously markets are very volatile at the moment and I want to give real kind of world experience on how some of these option strategies move around. And I guess this is going to sort of prove the point of automation. If you want to learn more about Options Autopilot, it is an automated options platform that I'm using, obviously that I created, and the info is down below. So I basically wanted to go over, do an update on positions and show where we're at now as compared to even a few days ago, and kind of show where the losses are coming from, what I've done to adjust or not done, and then also kind of go over just some general fundamentals of the market, kind of some insights. What do I think is going to happen? Not that I have a crystal ball, but just kind of, you always want to have a trading plan regardless. If you don't have everything automated, of course, you still kind of want to have a trading plan and just know how you're going to do things and when you're going to do them if you need to. So let's jump into this and kind of show what I've done more recently and where positioning is at. So you can see now P&L open is minus 3,100. This is obviously after hours now for the day. It was more negative. P&L for the year is, at least on my Tasty Trade account, it's down a couple $100. But then if we look at after fees, and again, remember I was up like $3,000 before fees, right? I think it was $2,500 after fees. If we look at year to date now, with fees, we're down 840. So that's a pretty decent swing. That's basically $3,300 swing in a couple days. That's definitely not ideal. But the reason I'm annoyed at myself, but I'm less concerned about that is about half of that came from my own stupidity from doing manual trades. And I'll show you those right now. So if we kind of look at, well, I guess we can just stay on there. Let's go back to that. So the manual trades I did was ARK and SOFI and Intel, technically NVDA, and VIX, I guess. So, but I did the SOFI, I did Intel a while ago. I did ARK, I did SOFI just a few days ago. So it's one of those scenarios where it's like, had I waited till today, it would probably look like I'm a genius. But it's just one of those things where it didn't work out. So for ARK, we can see I already took an $1,130 loss. So that's pretty annoying. So right there, that's about a third of the loss just from one position. And what I did was a short put spread. And at the time, it was like decently far down. I think it was a 15 delta short put. So let's look at it. I think it was a 15 delta short put at the time. So we can see, yeah, it was all the way up here. I think I put it on kind of, yeah, so I did do it on Friday. So I put it on and it was up a little bit. It was up $90 when we last looked at it. And then literally Monday comes and boom, all the way down. So I had quite a pretty big, protection here, or at least seemingly pretty far away from my short strike. My short strike was 45. It was a 45-35 put spread. And I took in about $1,200 of credit. So it was a good yield for the time. It was a 70-day put spread. So it was like 7% per month, but I guess obviously we're seeing why it was priced like that. And I didn't want to take just a directional play on Tesla or anything like that. So I kind of wanted to do a little proxy play. And this ETF has about a 10% exposure to Tesla. So it's kind of like you're getting a little bit of diversification. Anyways, blah, blah, blah. That was the thought process, right? Fast forward a few days later, and I got basically totally smacked. And I closed it out. And the reason I did that was at that point, my margin that was being taken up was 10,000, right? Because it was 10 contracts by the 10-point spread. So it's 10,000. It's a defined risk. It didn't change while things were falling, which is the positive thing. But then basically I had taken the loss, and usually if I'm doing a short put spread, not automated or anything like that, I'm probably going to limit it to 100 to 120% stop loss. So in that instance, I was like, well, I can get a better return on my capital over that 70 days now, because I'm most likely, best case scenario, getting back to break even on that. Who knows? It might end up finishing totally fine, right? But I basically was like, I can free up 10,000 and then reallocate that. So, and get it even more diversified, because at that point there was no guarantee that this was going to be beneficial, right, or come back. So that was why I took the loss there, and I was okay taking the loss there. But it still is super annoying, because otherwise, if we look at my Options Autopilot, we can see my P&L year to date is still positive. So this is all from automations. We might be missing one trade or something like that. But either way, this is what automation strategies has returned and done, versus the fact that I'm significantly losing money overall is all from the manual. Okay, I don't know if that's actually refreshing or what, but pretty much all from the manual trades. So let's look at some of the other ones currently open. Again, Intel down 1,000. It's technically only down 493, right? But we add that's about $1,600 right there. XRP, this is a manual trade technically. This is sort of unrelated. I kind of want to move all the stuff out, maybe to my Schwab account that I'm doing manually, maybe separate it out. We have automation on Schwab too, but we don't have futures options on there. Schwab doesn't allow it at the moment. They said they're going to work on it, but anyways, besides the point. So if we're looking at that, basically that's another $500 some. That was not automation. SOFI, also not automated. That was one I basically took a risk reversal, kind of expressing a long position. It's now approaching even more so the $10 kind of value range, I would say, but I don't really want to add to a loss. That's definitely one thing I would suggest not doing, even though it's kind of tempting since these are leaps. I'll have to assess. I'll have to do a little more research. But anyways, it's another $500 loss right there. So we can see that basically those few positions that I did manually are, what is this? This is 1,000. That is 800. Yeah, so that's basically $2,000 right there. So 2,000 of the loss basically is now coming from manual trades, versus had I not done those, I would technically still be up about $1,600 minus commission. So we'll say it's 1,100. Either way, it'd still be positive, right? So there wouldn't have been as much of a swing, which is good, but it's just annoying. But that's just how it goes. What did I do today? I didn't necessarily do a ton. I mean, this is one of our kind of test accounts anyways. I can move money in here if I want to, but I think a lot of this move was delevering for people. I think people are getting margin calls. I think we got to be a little bit cautious, because maybe there's still some margin calls coming. But you never know. I mean, if it gaps down tomorrow, I do think it's possible that we'll rally again into the end of the day. it was just very interesting today to watch. The fact that we rallied close to the close and then sold off again makes me feel like people were, again, kind of taking the opportunity to de-lever and avoid some margin calls. And I think that that could still be the case if we get more drawdown. I think the fact that Bitcoin was up today is actually kind of positive. That's kind of a risk-on indicator, I would say. The VIX didn't necessarily spike higher too much. Just trying to pull it up. I mean, if you go back and watch, again, I'm not, you never know the future, but I did say it's looking pretty toppy and talked about the double top and how far down it can extend. I think it can extend further, but these are the types of scenarios, and especially these are the types of scenarios that if you wanted to start automating, again, I'm not trying to plug it, just in general, if you wanted to start selling vol when it's elevated, and the market has now already corrected a decent amount, I do think it's a good time to start doing that. You got elevated, premiums, implied volatility, and the market has already come off quite a bit. Never assume that it can't get more oversold. Or, if you see an oversold reading, the old kind of saying is like market's going to become more oversold or even more overbought. Just depends on what it is. So you never want to assume that it's for sure going to be done. That's why you want to always manage your risk. Don't go full into something, still want to leg into stuff. But it would be a time to maybe start building some positions or selling some premium, I would say, in this kind of environment. I don't think the market's going to fall apart, but you never know. I don't have a crystal ball. But the fact that, we did finish lower, but VIX finished lower, possibly a bullish signal. Maybe that means we're getting near a bottom, but I don't feel like there's a ton of panic kind of selling, which also helps form the bottom. I didn't do a bonds position. I did do a crude oil, but I think that this would have been a really good place to do bonds. I just didn't do it today. I'll probably put one on tomorrow. But basically what I wanted to show also, what I did do today is I put on this crude oil 111. So I wanted to add a little bit of diversification because I usually will have gold on crude oil and bonds in addition to the market. So I'm definitely not following my own risk management, which is not correct. So don't follow what I'm doing. I mean, I have other capital, so it's not like this is like all my money, but it's just more of the allocation ideas that I wanted to follow have gotten out of whack, and that's just because I also have started to meddle with this stupid manual trade. So maybe I'll end up just closing all those out and keep Tasty all isolated for automation. But I did put on the crude oil. We can kind of see P&L year to date. We're actually down on crude. Because I did get stopped out, I believe. Actually, no, maybe that's that contract. Let's go look at the history. Because when I think about it, it does separate it out by contract. So you might be down on that particular contract, but not necessarily. Okay. So yeah, we're still technically positive. Does it have all of it? Yeah, we're still technically positive. But so we can kind of see and look here, right? Gold also, and again, I'm going to try and make this not that long. If you want to watch more of the analysis from before today, just go watch that other one. It's 40 minutes. But again, if you appreciate this transparency, thumbs up and like, share with somebody else. But you can see up year to date with the bond future options, that's all automated. MES were technically up. Gold futures were up as well. I think gold's toppy, but the point is to just keep doing it regardless of your opinion, because even when I was putting some of these on, I was like, oh, I'm going to lose money, but then I didn't, just because you just keep the automation running, right? So that's the whole point. Same thing, like when you're I got stopped out of some of my positions, some of our users getting stopped out of some of the stuff, but the point is, which I wanted to highlight, and why it's beneficial to use automation, just because psychologically when you're seeing that, it's fear and greed is the enemy of successful trading, basically. And what it is, again, we have to think about it as like we're an insurance company. And let's imagine, let's bring up SPY. Let's imagine, we're the insurance company and we are selling insurance. That's effectively what we're doing when we're selling volatility. We don't want to just do it on one asset class, because obviously that's like, to use a bad example, only insuring houses in Florida, and then hurricanes come through, right? So we want to diversify our portfolio. And so for an example, it's like, let's say you started up here. Some people do or were, and I've even done some positions, right? Definitely probably got stopped out. Now we're down here, volatility's higher. You've already moved this much further down. So when you're selling more volatility and you're selling it under the market, you have theoretically, you should have some cushion there. But the point is just to do it consistently, because again, even if you keep getting stopped out, as long as you keep doing it and you are managing your risk, right? At a certain point, you only have a limited amount of capital, but you don't want to risk the farm or risk any large amount. I would say 5% or so per position is typically what you want to follow. But anyways, you're selling under the market, so theoretically you're kind of de-risking, but you're getting a higher implied volatility. It'd be like an insurance company coming in right after a hurricane and offering hurricane insurance, right? They're going to charge a crap load of premium because they need to be certain that they're going to, be able to cover their losses. But you have to do it obviously across enough people, across enough whatever houses, same thing, doing it across enough trades, right? The issue is that even I've been selling some put spreads that are 10 delta, right? So that's approximately on the short put, that is. That means that there's a 90% chance that does not finish in the money. Now, I've had my stops a little bit tighter, so I've been getting stopped out. But theoretically, that should be 90% win rate, right? Long term. But that's probably over 100 trades. So you could technically have 5-10 trades in a row where you're getting stopped out and it seems like, oh, this strategy doesn't work. Technically, options should be efficiently priced. It just takes a while. So that's very difficult. That's why you kind of want to diversify both across asset classes and across strategies. For the most part, I'm doing one-on-ones and put spreads. I might do some other stuff in the future. Stay tuned for that. But for now, I do like the one-on-ones, and I'll touch on that. I always just think of things that I need to cover, so then these videos go way too long. But hopefully it's helpful to people. So you can see these MESs. These are left over. I switched to ES. But see how these are in the money? That's how much the market has fallen. Like none of these were in the money. Well, maybe I think this one was in the money on Friday. And now all of these are in the money. Like that's a pretty massive move. And excuse me, that's basically just how quickly things can turn around. I had an extra put spread, and those were technically hedges I left on. So on Options Autopilot, you can have it where it just will close the short put and then leave the long put spread on as a hedge. We had two on. I closed one for, I don't know, probably a 50% profit, or I just wanted to take one off and kind of leg out because I thought the move was getting a little bit extreme, but I left one on for I guess safety purposes. So technically this should expand up to 100 points, right? And that's kind of the benefit. And who knows? We'll see what happens. I kind of want it to sit around here because all of these long put spreads are in the money right now. A lot of the short puts are still significantly out of the money, right? And anything's possible. I can't imagine the market's going here in even 3 months, but you just never know. I just kind of want things to sit around. You can see that I've got pretty high theta over here, $169 technically a day. I don't think that that's actually gonna happen, but let's go look and see what else we got over here. I mean, I'm pretty short vol, as you can see, right? So it'd be great to get a little bit of a drop in the VIX. That's going to obviously significantly help. But that's one reasons I like the 111 is it's kind of a little bit flexible. The 112s can really get hit because you're short that extra put. We do have the ability to do the 112, but this would be where I would be putting on the 112, where you've got a higher implied volatility. So hopefully you've got a little bit better chance of success and you're getting that extra credit. It just takes up more capital. And you really always got to learn or live to trade another day. So I wouldn't fully stretch. I would probably just put on another position instead of. So you can see I've put on quite a few ES positions. So I've got this 1, 2 on here. So I basically have 3 111s on ES at the moment. And you can see that in general, this is really not down that much. This one's down a little bit more. Obviously, I put this one on a little bit, like a few days ago. So obviously, it's going to be down more. But in general, I think my credit is probably 700 some, $800. I have to look for sure what the credit was. But I'm just hoping that it kind of should work its way. We get a little bit maybe of a bottom. If not, I'll get stopped out. I'm giving some of these positions, again, don't follow anything I'm doing. This is my own personal money. I'm giving things a little more room. Typically, I'd have a tighter stop loss because we've taken such a drop, and I'm pretty good with all these levels. I mean, again, if the market's getting down to 48.50, I'd say it's potentially a good buying opportunity just to be long the market. But we do have, the long put spread to help us. Bitcoin finally working today. I got stopped out of one of the put spreads. There's just one. It had done 2 trades separately. So you can see that it's pretty high above this short strike. So who knows? I think it'll be okay. But you can see that I've been stopped out. It hasn't been successful year to date on Bitcoin. So we'll see. See what happens with oil. Again, I want to go through the charts, but it just ends up taking way too long. But I'll look at it real quick. So yeah, I do think oil's coming into a scenario where there's potential for people to find value, or it's gone all the way up to 78 and then come back down to 66. I mean, you just never know what's going to happen, but I think it's a good time to be selling put spreads. And the fact that we're still up, even though all this has happened, that just is a testament to doing it consistently and staying, I guess, consistent with it. So one other thing I want to touch on, and I'm going to do a different video on this. Everybody talks about technicals versus fundamentals, and I'm going to do one on my opinion on all those things, but I just wanted to touch on what some, people will look at and where we were and where we could get to just as reference. I would say this kind of feels similar to 2022, and just in terms of where, PE ratios were elevated. I mean, they were obviously even higher during 2022. And things came down. But just as an example, I mean, they basically got as low as 18.65. I don't know if this is up till today. Yeah, I don't think it is. So it's probably even lower than this now. So I think we're getting close to forward PE ratio around the 2022 level. Again, doesn't mean it couldn't get more depressed, or if people start ratcheting down their EPS expectations. But I would say it's helpful to then kind of look at where does that correlate with the market. This is FactSet. You can go and find this if I Googled forward PE and EPS. This is from March 7th. So again, it's changed a little bit, but you can see where the market was. And this is like current EPS expectations and the price level of where it was. And now we can kind of look and see, okay, if we're just going to round and say it's $280 of EPS, and the market finished at, I think it was 55.72. Oh, okay, well, depends if we go ES or let's go off of SPX. Still feel like Tasty Trade's kind of clunky, but whatever. It's good for automation. Give them credit for that. So yeah, 55.72. So if we're basically taking 55.72 divided by 280, 19.9 times. So we're getting closer to maybe a point where people find some fundamental value. What I would say is you kind of want to plot that stuff out. There's no guarantee that will be paid attention to at all, but it just might be more of a place where fundamental investors, institutions might be like, okay, this is maybe getting a little overdone. The other thing is I'd be curious, and I'll have to do a little more research. I'd do it for the next video in terms of the fundamentals versus technicals, how much the Mag 7 is influencing that PE ratio. So I know there's a lot of stocks that are probably pretty cheap, and interestingly, some value companies have been rallying, in the past week. So there is some lower correlation of the market, and you just want to look and see what is the maybe PE ratios of the stock market outside of the Mag 7. And that might help inform some of your investment decisions there as well. But in general, we're just focusing on the options right now. But I just want to give some of those insights and maybe some ideas for you to help yourself. And if you have questions, another, plug for if you want to learn options, whether manual or not, we have a full course on trading options on Options Autopilot. Just request access and you will be able to get access to that course. It's free. I tried to make it so if you did want to manually trade, I went very in depth. It's pretty technical, but I do think it's critical to understand, even if you're automating these things, to know why you make money or why you might lose money. So that's why I wanted to put that up there. So appreciate you guys watching. If you like that, transparency, we'll see what happens now. Like I said, I'm hopeful that things kind of start to bottom out, but I would say if we get more of a downdraft tomorrow, it's going to be generating some more margin calls for people. I think there's a way to see overall broker-dealer margin levels. I just haven't looked, and I don't want to make this any longer than it is. But just watch out for that. I think if we kind of gap down tomorrow, starts to sell off, you'll probably get another scenario where it gets a downdraft and then people are forced to close out, and then it reverses. I mean, that's the annoying thing about all these types of moves is, we don't have any of the orders sitting on the market, so it's not like market makers can see where our trades are. It's triggered based on your stop loss percentage, and then it'll send once it's ready. But it's just annoying because they can probably see open interest and levels of interest. So if things get pushed down and then people are forced to close, market makers get off balance and then they have to buy stock or something. That's just how it works. It gets annoying because usually it'll happen right beforehand. It'll trigger you out and then the market reverses. At least that's how it seems. It hasn't really happened that way once introducing automation. It shouldn't matter long term, but that's just how it can feel sometimes. So watch for that. I'm feeling decent. I might move some more capital into this account in case we keep selling off, because these are the opportunities when vol spikes. Again, you got to manage your risk. Don't go too heavy. I definitely would add it to other asset classes. I'm not necessarily going to go more S&P 500 because that's probably going to be too much exposure there. I'm already over what I wanted to be. So just keep your risk management, keep your rules in place, just follow them, and just live to trade another day. And then just focus on the fact that there's still a whole year left, and if you can still crank out a couple percent a month, or even be like, I would still be up if I was not stupid with my other positions, but just basically stay consistent. You should be able to make money long term if you can stay consistent. So just be cautious, but be optimistic that you have an opportunity to take advantage of the market. And I think this is one of those times where if you're waiting for a pullback, here it is. And if you're waiting for a VIX spike, here it is. Just always know that things could get worse, and you want to manage your risk and leg into things. So hope that's helpful, and we'll see what happens tomorrow, and maybe we'll have another update in another couple of days, and we'll see what happens there. Thanks for watching, and we'll talk to you later.